Good evening, friends, and it's been wonderful to connect through the virtual mechanism. And it's so nice to see so many friendly faces. And I could quickly scan through the participant list, and there are so many friends here. So, hello to all of you, even though I cannot see you personally. First of all, congrats to the CTC for picking up a wonderful topic, and another round of congrats to eliminate software out of it. Because if software had been there, we wouldn't have proceeded any further beyond case study one. And in that context, to eliminate corporates and focus on IPR, it's a very, very innovative idea, and not many sessions have happened on this topic at all, to my knowledge. So this would be very enriching to the members. And I had an occasion to go through the presentation of the speaker today, and it is an excellent one. All the issues in trademark have been beautifully captured, and perspectives are well structured. I also had a long chat with him, and I could see his depth of knowledge. So I'll play the role of a chairman. I would not step into the role of the speaker today. So just to do a minute on initial thoughts. Well, GST is quite funny that in one side of the side you have businesses which are obsessed with getting their trademarks registered. They're obsessed with getting their IPR in place so that they can improve their brand and valuation. And on the other side of the spectrum, you have an exemption for paneer or some other product without a brand name or a trademark. And that caused an interesting development in the trademark registry, where many businesses ran to the trademark registry to cancel their registration of trademark because they didn't want a trademark for the sake of no rate or exemption. Then the government had to tinker with the exemption notification and add all kinds of clauses in terms of declaration, things like that. So, just because of GST, IPR had so much of impact, just to set the tone for GST discussions. And as far as the speaker is concerned, he's covered the length and breadth of the trademark-related GST issues. Some of the issues are likely to occur in the future. So I would request the audience to focus on the facts so that we can understand what he's talking about and then see his perspective. Over to the speaker.
Thank you very much, Vaidhi sir, and it's an honor to have you as the chairman. It's always a guiding torchlight always helps. So thank you very much for accepting to be the coach for this presentation. My sincere thanks to CTC, Pranav Bhai, Atul Bhai, and Naresh Bhai. Naresh Bhai is not here in the meeting, I understand, but sincere thanks to all of you to give me this opportunity. Any such opportunity forces us to go back to the book and read even more than what was read in the past. And it only is more and more enriching. So I am thrilled to make this presentation before you. And when I was thinking through how we should run these slides, the attempt that I've made is to capture issues which are more likely to occur in our day-to-day matters first. Those issues are also addressing point aspects, which are not hyper-technical, legal, interpretative aspects, but more about a point of view aspect of how should we read the law, how is the law framed around some of these more regular issues. That's how the case studies evolve. And then we go into the slightly more complex realm where some of these very large transactions that we hear of, how are they being looked at in the past and how would they be treated in GST? As Vaidhi sir has already said, and thanks to him for that, GST is clearly a funny law. There is a lot to evolve on this. And I expect that there will be a lot more action beyond what we are covering today. But certainly there is a point of view that each one of us can have on some of these matters, and that's what I would like to share with you. As Atul Bhai was suggesting, we've tried to make sure that we are focusing on a slightly narrower topic. We are not covering copyrights. We are focusing on patents and trademarks. And again, within patents and trademarks, the maximum case book, as you will see in terms of legal disputes, is around trademarks and brands. And I'm using trademarks and brands as a proxy for helping all of us understand the nuances. If certainly there are questions after that, then we can look at questions beyond trademark. But if we take one proxy, it helps us get a refined understanding of what the legal provisions are. So that's really the way in which the slides have been constructed. So if we go to the first case, and I'm hoping you would had a chance to go through the facts, but let us just concentrate on what the question before us is. That there is a company here, Sky India Limited, which is negotiating a possible sale of its brand, Shooting Star, to Space India Limited. The company tax team is understanding and analyzing the GST provisions around whether there is a specific provision on sale of IPR, what is the nature of this transaction, and they have a question of whether this will be supply of goods or supply of services. So the most basic question is what we start with. What they've stumbled upon is that they've seen notification for goods, which is at entry serial number 243 after the November 2017 amendment, which says permanent transfer of intellectual property right other than software, 12%. So 6 and 6, and therefore 12. So this is the goods rate notification that they've examined. When you go to the next slide, they have also presented to us the service rate notification. The service rate notification 11 of 2017 tells us under heading 9973, which has the caption or the marginal note leasing or rental service with or without operator. Under that, there is an entry which says temporary or permanent transfer or permitting use or enjoyment of intellectual property right in respect of goods other than information technology software. Now, if we would have already noted, the entry 17 under service tax notification, which refers to 9973, is very, very similar to the previous entry that we saw on the previous slide. The only difference is that the words temporary or are added primarily to that entry. And of course, the permitting use or enjoyment of. So what we saw on the previous slide was permanent transfer of intellectual property rights other than software was at 12%. Here, the entry suggests that temporary or permanent transfer is liable at 12%, but as a service. So now Sky India Limited is approaching us to understand whether this transaction is a supply of goods or services. Is it a question only limited to the technical correctness of whether it's goods or services? Because the rate of tax is the same. The goods notification suggests it is 12% and the service notification suggests it is 12%. And therefore, whether you qualify this transaction as a supply of goods or supply of services, the transaction will still attract the same rate of tax. And therefore, why should we worry about the way the clauses are worded, and why should we really have the big question of determining whether this is supply of goods or supply of services? As we all know, the perspective is significantly driven by what is the place of supply. We are aware that Section 10 and 11 under the IGST Act is linked to supply of goods, and 12 and 13 are supply of services. And in both cases, therefore, if your transaction is a supply of goods versus a transaction of supply of services, the outcome of tax, i.e. whether it is taxable or not, and the type of tax, which is whether it is CGST, SGST or IGST, can possibly differ. So getting the first step right in the sense of determining whether this is supply of goods or supply of services is an important question to be addressed. We are looking at overlapping entries, and therefore we need to take a decision from a technical standpoint of which entry will more appropriately apply. If we look at the ways in which we can resolve this conflict, on the next set of slides, I have provided a perspective on how we can deal with this. We of course know the goods notification we already read and the service notification we already read, and we noted the permanent transfer as well. But as we move forward on the next slide, we should also note that the same notification 11 of 2017, which is the service rate notification, has an explanation 4 small Roman 2. The explanation states that references to chapter, section, heading, wherever they occur, unless the context otherwise requires, shall mean the respective chapter, section, and heading in the annexed scheme of classification, i.e. annexure. So this is a very important classification determinant, and I'm sure in the process of advising our clients in determining classification, we have looked at the entire list of classification and then determined the rate. The importance is coming directly from the notification. The notification incorporates the annexure as a part of the notification itself, and therefore any determination of classification dehors the annexure may land us up in an error of judgment. So any notification entry of 11 of 2017 that we are trying to interpret from an application standpoint to determine the rate of tax should be read, because of this explanation, to mean the entire list and not just the entry as we are reading it. So if you look at the entry which is 9973, which is what the rate notification was referring to, the 99733 heading says licensing for right to use intellectual property and similar services. I have extracted that here in the slide. We should note that here, while in the rate notification it said temporary or permanent transfer, but in the annexure it refers only to licensing. It says licensing services. So the explanation takes us to a schedule of list of items that are covered at 12%. And that schedule has the title licensing services. It does not have temporary or permanent transfer. If we go deeper into that annexure, the small highlighted line, as you see, 997336, talks about licensing services for right to use trademarks and franchises. So again, the operative entry which we have to worry about for our Shooting Star brand is 997336 if it is a service, and that entry talks about licensing services. So when we read the explanation, we read the caption heading of the group 99733, and we read the taxing and the classification entry 997336, we can certainly conclude that what is covered is licensing services. Now, this should certainly raise an interesting question in our minds as to why then the taxing entry had temporary or permanent transfer. And we'll get to that in a minute. When we see the next slide, we have further compelling evidence of understanding what went into designing the way it is. The first is that we've already noted that there is no assignment covered in 9973. The second interesting aspect is that through Article 246A and all the articles that follow, the GST Council is the prime recommendatory body for determining what should be the operation and the framework of GST. In its minutes on 19th of May 2017, just before GST went live, the GST Council had approved the schedule of rates. So this is available on the GST Council website, the meeting of 19th of May 2017. In the minutes, it is very clear that temporary transfer will be regarded as a service. And then the minutes say, and it will be taxed at the same rate of 12% as a permanent transfer would be taxed. So this is a very, very important element, and I have personally, in other cases, not in this particular matter, but in other cases, found very useful insights in going through the minutes and the discussions at the GST Council to understand and interpret what has been the purpose of a particular amendment, what is the realm of that amendment, what was the mischief that was trying to be addressed, or what industry representation was made, and that gives us tremendous amount of clarity in interpretation. So the purpose of putting this bullet was to highlight to all the members that it is important sometimes to go through the GST Council documents, because from a constitution perspective, the GST Council has the recommendatory power. And therefore, whatever is formally documented in their discussions will carry some weight where we are unable to resolve the discussion based on what is available in the law. Of course, we know that Schedule 2 of the CGST Act, which is referred back in Section 7, has an entry 5C, which says temporary transfer or permitting use or enjoyment of intellectual property is a supply of service. So there is significant compelling evidence for us to conclude that for the first case study that we dealt with, the Shooting Star brand, if it is being assigned, it is going to be a transfer of goods or a supply of goods and not a supply of service, although there are overlapping taxing entries in goods and supply of services schedules. Again, there is a press release which is interesting and which throws light on the conundrum that exists around taxing intellectual property. The press release on 10 November 2017, when this amendment happened, says that in order to obviate dispute and litigation, it is proposed that irrespective of whether permanent transfer of IP is a supply of goods or service, permanent transfer of IP other than information technology software will attract 12%, and permanent transfer of IP in respect of information technology software will attract 18%. So the GST Council and the press release following the meeting of the GST Council is clearly bringing out that this is a challenging topic. There can be various interpretations, arguments. We are looking at very simpliciter transactions in terms of assignment versus licensing. If we make it more complex to say that I'm doing an assignment only for a territory and I'm not doing licensing, what will be the result? As Vaidhi sir rightly guided us, that it all depends on facts of every case. But if you understand the position set out by the government is very clear that we will recover 12% tax on this transaction. And all the leading information around the taxation of IP transactions is suggestive of the fact that if you have a permanent transfer, then you should worry about the provisions that are relevant for goods. And if there is a temporary transfer, then we should look at provisions around services.
Thank you, Divesh. And that was a very good case study, and it set the ball rolling on this issue very well. And you have flagged a very important topic. This is probably because of, I don't know whether it was design or it was just a part of the urgency through which we pushed this law through. In the pre-GST era, we had this problem. And when in 2004, when service tax brought into tax intellectual property rights, context of temporary transfer of permitting to use, the board did clarify that they seek to transfer only temporary transfer and the permission to use, and did not want to tax permanent transfer, because they said permanent transfer would be treated as a sale. And that particular observation was also noticed, and the Madras High Court in the case of AGS, even though it was a dispute in the context of levy of service tax on film industry, in the case of distribution and producers and the copyrights, the Madras High Court did elaborate on what is an intellectual property right, and then went on to clearly in one specific para say that a permanent transfer can never be a service, it is a sale. whereas a temporary transfer or a permitting to use as a service. So we have some kind of judicial thinking on that in quite elaboration. But as you rightly said, the notifications are conflicting in nature, specifically the language in the entry. The larger question would be the role of the annexure, because as you rightly point out, what would be the impact of the annexure, which is part of the notification by reference. This is going to be a huge challenge going forward, because unlike the pre-GST, when we had a very clear tariff for customs and excise, and the rules for interpretation was quite clear. In terms of services, there is no clarity as to how to interpret entries within the service notification. That can be challenges that can get thrown. And one more challenge that can come up is people could enter into what is called as a perpetual license. So there are transactions where a license is given for a perpetual period. They may not term it as assignment. Now, if we go by the licensing as a terminology, you may get into a challenge there as to whether it is service. And you're right, dot on when you say that the rate is not the issue. The rate, it goes beyond that when it comes to place of supply. And being goods or service can make a huge difference. So members, going forward, what you should look at is how is the contract drafted. If you're looking at an advisory post-transaction, of course, your hands are tied. But if you're looking at some kind of discussion or participation in an advisory exercise where some kind of transaction is consummated, it is important that the lawyers who are involved in drafting the contract also understand the impact of what would be if it is an assignment, what would be if it is a license. And that angle can make a huge difference later. I fully agree with the answers given by the speaker. Please go forward.
Thank you, sir. Thank you for your inputs. So we now move on and we look at the next case study. Now, this case study is again slightly different from the first one. Here we have Moon India Limited, which is the subsidiary of Earth UK Limited. So you have a UK company having a subsidiary in India. This subsidiary is engaged in two activities in India. It is importing and selling Earth's products in India. It is also importing parts and manufactures Earth's products using IP and then selling those products in Indian market. So we can take a simple example. The favorite could be any, let's say, IT products. So you are importing IT products and selling them, and you are also importing parts, getting the know-how of how to manufacture that product. You have a factory, and in that factory you are now making those products and selling them, right? So we also have an additional fact in the case study that 20% of the products that are sold are exempt from GST. And this particular fact pattern has been put in for a reason, which we will come to in a bit. Now, the facts further are that Moon Limited is paying royalty to Earth. So there is a 2% royalty being paid, but this royalty is being paid for sale value of manufactured goods. So in my second activity, which I am importing parts, assembling and selling the IT product in my example, I am paying royalty of 2% on the sale value of those IT products. This royalty has been accepted under transfer pricing. So certainly any payment that we make to a related entity will go through the rigor of transfer pricing. And again, the facts before us are that this transfer pricing has accepted this royalty. But now GST has come in. Things were all okay in the service tax era. Transfer pricing was all okay. But with GST, the tax team of Moon Limited is worried about Schedule 1 Entry 4. And Schedule 1 Entry 4 basically suggests that any activity which is supply, even if made without consideration, includes import of service by a taxable person from a related person or from any of his establishments outside India in the course or furtherance of business. So if you are importing a service from a related person, then it becomes a activity which will be treated as a supply even if without consideration. If we go to the next slide, there is absolutely no doubt that the parties are related, and there is absolutely no doubt that Moon's import and resale business is a business activity. So if you again look at the entry says import or service from related person in furtherance of business. So yes, related, yes, business activity, question, import or services, right? Now they've looked at Rule 28 of the CGST rules, valuation provision, which we are aware of. And they have looked at the proviso, which basically says that if full input tax credit is eligible, which is the last line on your slide, value declared in the invoice will be open market value. Otherwise, the rule requires you to follow the open market value. If you don't have open market value, then the value of like or kind quality goods or services. And then if you don't have that, you go by Rule 3031, which is going to follow in the coming slides. Now the question, therefore, which is posed on the next slide for us is that whether 2% royalty currently being paid under GST, which is accepted by transfer pricing, can it be challenged under the rules? So the first question is that in the manufacturing and selling model, where I am paying royalty of 2%, is it possible that the GST authorities are going to tell me that no, I don't agree, it is 2%, it should be 3%, let us say, and therefore you have to pay reverse charge on 1% extra. So is it possible that this royalty will get challenged? And the second question is that will they be required to self-impute a royalty for the import and sell model? Because of the fact that they are not paying any royalty for this business. There is no transfer pricing precedent naturally. And transfer pricing precedents may not exist for this because it's a payment. So transfer pricing officer will analyze a payment to allow you a deduction. If you're not making a payment and not claiming a deduction, he couldn't care less to evaluate whether you should have paid a royalty in the first place, unless you are in a particular type of transfer pricing model, which we are not getting into. And again, the question is that can the proviso of Rule 28 be taken, which means volume in the invoice has to be accepted. So that's really the question. So as we see now in this case study, we have a royalty paying business where valuation is the question. And we have a non-royalty paying business where taxability is the question. And once taxability question is answered, obviously valuation is the next question to be answered. Let's move forward. So how do we solve this question? Okay. Now, we have a definition of supply. There is a deeming fiction now which says that any transaction between related persons, even without consideration, is a supply, right? So in the second case, which is the import and sell case, are we in a situation where it's no longer a question of taxability, but it is primarily only a question of valuation? And that, to my mind, is a question which can present itself in many, many ways. If we see the next case study, we've extended these questions in a slightly different fashion. But the primary fundamental issue that we are trying to deal with here is that when there are related parties in a particular transaction, and there is, in this particular fact pattern, a trademark certainly involved because I am selling products of Earth Limited. So I'm using maybe some trademark of Earth Limited. And that's why I'm paying royalty in the first case. I'm not paying royalty in the second case. So for the use of this trademark, for which I am being able to sell the products, although it is not admitted between parties that there is a transaction of supply triggering royalty, is there indeed a transaction of supply because of the deeming fiction under Schedule 1, Entry 4? The repetitive word and question that should come to us every time is that the emphasis is on the existence of a supply, right? So is there a supply? The second part, which is that the supply is without consideration and therefore we'll attribute consideration, we'll go to Rule 28, we will do OMV, which is open market value, LKQ, which is like or kind quality. All those are later questions. My primary question always remains, is there a supply? Now, supply is defined, as we all know, in the widest manner. And therefore, to answer the second question, we will have to look beyond what is available in GST law to get the final responses. Now, OECD, as we all know, is a leading institution which has published several qualitative thought papers on how international transactions should be taxed. OECD has published very, very good quality documents, and I will recommend members, whoever is dealing with any intellectual property cross-border transaction or cost contribution arrangements cross-border, should certainly go through those papers. Very beautifully considered and analyzed use cases to explain what the fundamental concept should be. And the OECD guideline for related party transactions, especially on intellectual property, talk about the existence of benefit. So as long as there is an economic or commercial benefit accruing to the recipient, there is a supply. So is there, therefore, to put it as a question, is there an economic or commercial benefit to the recipient? Now, it is not a simpliciter question of whether there is an economic benefit or not, because what is an economic benefit in itself is a significant matter to decide. Let us say that I am a person who is importing and selling a branded product, and I am able to therefore earn a particular margin, and I am able to make a profit in the transaction. At the same time, I have the subsidiary Moon Limited, which is doing the same activity, correct? Is Moon Limited, being a subsidiary of Earth Limited in this case, versus me, who is, let's say, a third party importing and selling Earth Limited's products, is Moon Limited positioned differently from me? Does Moon Limited get a differential economic benefit or a differential commercial benefit in the import and sell transaction? It's a very sharp question of facts. There is no straight answer to this. There is only guideline that we can follow, tests that we can apply, and then make a determination. But in a simpliciter situation, if we go to the next slide, in a simpliciter situation, the first case study, if we first answer, the first case study, there is an admitted supply, and I will come to the second case study in a bit. But for the first case study, which is a case study focused only on valuation, for the first question, which is the case is only on valuation, the determination to be done is whether it is open market value or not, right? We know that benefit of Rule 28 proviso will not be available because there are exempt products, and like I mentioned initially, that there was a purpose of putting this. Otherwise, there is a very straightforward answer that the value on the invoice, which is 2% royalty, will have to get accepted. But with the presumption that you cannot accept it, we will have to go into testing the valuation. In the next case study, we are presenting an analysis between transfer pricing, customs, as well as GST valuation rules and valuation methods. For this case study, I want to present a point of view to say that if the transfer pricing study is qualitative, if the methods that are used for transfer pricing are reasonably aligned to GST, and we will see the methods of transfer pricing in the next case study, then the transfer pricing determination of 2% royalty should have a strong persuasive basis for us to argue that there is no 3% possible here, that the 2% is fair, that there is alignment, there is an independent wing of the same government who has accepted the approach that is followed. The valuation has been accepted and settled. We are continuing to follow that valuation. It is the valuation agreed and settled between parties, and we are not talking of only one country being involved. Obviously, there's a country on the other side. The country on the other side is wanting to tax income. The country on the other side is possibly giving zero rating for the income earned royalty, because for them it is an export of service. And the country on the other side may eventually be giving some export incentives to the exporter. So in an international transaction where transactions have been tested and analyzed between parties, and the commercial consideration between parties has been accepted fairly, there is a strong persuasive evidence with us to argue that the 3% does not exist and the 2% should be accepted. Certainly, there is a need to draw comparison between the TP methods and the GST methods, and which we will cover in more detail in the third case study. If we go to the next slide, we are answering the second question. The second question, like I said, is more about whether there is really a supply and whether there is really a benefit. If my business model is fairly comparable, the business model of Moon Limited in our example, is fairly comparable to a business model of a third party who is importing and selling, then to that extent, there is and there should be no need to impute a royalty in the transaction. A royalty for the trademark should come in a situation where I am getting a disproportionate advantage out of the transaction, not merely because I am positioned in between the manufacturer Earth Limited and the ultimate buyer in India. And therefore, to that extent, import and sell models should not suffer the risk of attribution of trademark royalty as a manufacturing business will suffer. Very interestingly, there is precedent available in the transfer pricing world globally on this, and there is enough writing material available that if you are a LRD, limited risk distributor, in a transaction, then you do not receive any benefit called trademark royalty or trademark advantage, because your comparable set in transfer pricing to justify the margin you are making in India are independent third-party distributors, where you compare and justify, have you received the same margin or have you earned the same margin as a third party would. So I would conclude by saying that my final argument would be that existence of relationship in the transaction cannot result in a higher tax as compared to a transaction where the relationship was absent. That may be a completely obtuse outcome, and therefore in the case study 2, for the first question, transfer pricing is a persuasive evidence and we will analyze in case study 3. For the second question, in my personal opinion, there should be no attribution of royalty because it's a comparable third-party distributor model where you are only acting as a limited risk distributor.
Thank you, Divesh. And it's a very good question in the sense that it interplays so many issues. Members could probably look at a little more perspective from the customs law, because some of these issues have been debated there in different contexts. Just give an example. Let us say there is a Indian subsidiary which decides to set up a manufacturing plant, and the holding company supplies significant equipment for the purpose of setting up this plant. And in addition to the equipment, it also supplies know-how. And for the know-how, there is a payment of royalty. There is an agreed royalty. You have a technical know-how agreement through which the royalty is being paid. The royalty is to be calculated based on certain parameters. There is a clear definition as to how the royalty is to be calculated. Now, the customs department was always of the view that the valuation of the machinery can be suspect. And between the parties, because they are related, they wanted to add the royalty that was paid for the know-how to the value of the equipment. And similarly, there were transactions where somebody had a royalty for a know-how, and trading transactions, import and sale, was also happening with the same parties. And the same attempts were made in the customs law to say that the royalty can be added to the valuation, and the valuation was questioned because the parties were related. There are enough precedents where the courts have gone deep into it. Supreme Court judgments are there where they've established that please look at the nature of the transaction. Please look at why royalty is being paid and for what it is being paid. The terms of the contract will establish that the royalty is being paid for the usage of specific rights or know-how, etc. You cannot travel beyond that and add it into an alien transaction of supply of machinery. So if you draw inference from that, the limited risk distributor has got one element of business where he buys and sells goods, and there is another element of business where he's paying a 2% royalty to it. So to insist that you must self-impute royalty and identify a percentage of royalty to create taxability, as the speaker rightly says, is incorrect. And if you look at judgments such as JK Corporation of the Supreme Court or Mahindra Mahindra, you get enough literature as to how know-how and all these has been factored. And the key factor would be how royalty is defined and how royalty is calculated in the agreement. Now there are other issues as which the speaker has also highlighted. Whether all this would suffice and the department would keep quiet, I have my doubts. Because if you go back into the pre-GST regime, we have a live issue of show cause orders being issued to banks, where banks have been asked a simple question saying that you have account holders whom you are giving special benefits. You're giving them free withdrawals from ATM without charging, and why can't we impute a consideration towards that? You have a dispute, live dispute going on courts. Then you have disputes in service tax where somebody has done what is called as a factoring business, where there are receivables which are assigned to another company, and the other company, it was just the collection exercise and is paid a very small consideration. So the department has questioned the adequacy of the consideration and said that no, we can impute some more consideration. So there would be definitely an issue, an attempt to create taxability even for the first transaction. I have no doubts on that. But the answers which the speaker has given would be adequate arguments to contest that matter. Now, coming to a larger issue, which I thought I'll just park and probably take the speaker's thoughts also on that, would be an interesting dimension could be from how we would read the charging section. The charging section of Section 9, which talks about levy of GST at the rates, so and so, so and so. It is linked to a rate on a transaction value determined under Section 15 of the CGST Act. And if you read Section 15, subsection 1 of the CGST Act, it says price paid or payable. 15.2 talks about various additions which are all familiar with. And 15.3 talks about scenarios where value cannot be determined. This is not a case where value cannot be determined. So if you read Schedule 1 and Section 9 and Section 15, probably an interpretation which can come forth in the future is that the chargeability mechanism is inextricably linked with Section 15. And without a price in a transaction, any attempt would be contested. And that would have probably be a later thought process. Now, coming last to the point of transfer pricing, I'd be glad if transfer pricing is accepted, because in my experience, what is happening is the TP authorities don't like customs valuation. The customs valuation does not like TP authorities' TP perspective. And it is an interesting debate. Of course, some judgments are from ITAT have now kind of looked at customs valuation and some kind of. As the speaker is right, when the questions are the same. See, fundamentally, what are we looking at? They're looking at this concept of related party transaction with the presumption that something could be wrong. Because both parties are at a convenient mechanism that prices could be structured. In fact, if you read the Bombay Tires judgment and MRF Tires judgment, when Naniji argued the matter, one of his arguments was that how can you prohibit me from dealing with a related person? And the Supreme Court responded by saying that we are not prohibiting you, only regulating the valuation. So from that perspective, the government would try their level best to see if something can be included. But I fully agree with the answers, except that the taxability issue can still be a matter of debate going forward, and it requires significant arguments to counter it, given the fact, and it's also important that the market intangibles point can also be marketing intangibles can also be a very relevant factor. For example, the royalty could be paid for a know-how, which has got a brand. And the goods which are imported may also have a brand. So can somebody say that the brand building exercise is being done? And whether the limited risk distributor concept, which is there from a profit computation perspective, would be relevant from a GST perspective, will be interesting.
Thank you so much, sir. And I'll just share one thought on the question that you raised, sir, on 9 tied with 15, and therefore what is the interpretation of Schedule 1. I agree with your point of view, sir, that that the way 7, 9, and 15 are constructed, there is certainly a case to say whether Schedule 1 at all can be made effective. And I'm just anecdotally sharing that we did raise this issue before GST went live with the GST Commissioner's office in Delhi. And what we were advised is that Schedule 1 actually was an entry made in the last minute to make sure that taxpayers do not lose input tax credit on these transactions. So to basically continue the input tax credit chain, so the example that was given is, if you look at entry 1, which is that if you dispose any asset, then if it is not a supply, then you lose the original credit. So even if you scrap something, I will deem it as a supply. If it's a third party, then valuation can still be zero, because Rule 28 will not be required to be followed. 27 will be required to be followed. So valuation can still be zero, but you can protect your input tax credit. In the same way, principal and agent. So principal can transfer the credit to agent, and agent can transfer the credit to customer. So the objective was that, but of course, inserting entry 4 was a was a different piece altogether. So but thanks a lot for your input, sir. Moving on to the next case study, it's a small variation from case study 2, like I said. And the variation I have added here is that now we bring Earth Limited into India. And we say Moon and Earth are both in India. So Earth is no longer in UK. And domestic transfer pricing does not apply. So now you don't have a transfer pricing study. You don't have any protection that 2% is appropriate, not appropriate. And now we have to evaluate whether 2% is appropriate. Okay. And how would you go about doing this? So this case study is more about the practical implementation of how we are seeing companies prepare themselves for the onslaught, like Vaiti sir mentioned, that is going to come to us for matters where you have determined a value in related party transactions. You do not have probably directly comparable transactions. You do not have a transfer pricing study to protect you. Then how will you deal with these cases? And there can be many examples in real life that we may be seeing today. A simple example could be that in the Tata Sons judgment, which is the Bombay High Court judgment, it's a reported matter and therefore facts are in public domain, that the Tata Sons entity trust was charging a brand royalty. Of course, the question of whether it's supply of service or it's liable to VAT, etc. But there, as we know, there was a royalty being charged for the use of the Tata brand. And therefore, the question of which tax to apply. But what if you had a same group, a similar group in India, where there was no royalty being charged, right? Or what if they had determined the royalty to be 2%, like we said in this example, and now they don't know whether this 2% is right. And why would they not know? They would not know because, let's say if it was actually Earth Limited in my example, and Earth Limited had 50 subsidiaries and they were all paying 2% trademark royalty. Earth Limited certainly would not be giving this trademark to a third-party distributor in my previous example, or to some other company which is doing the same business, right? Because they would obviously give it only to subsidiaries or group companies. So there is no comparable set available. And it's a domestic transaction, so no transfer pricing test has happened to this 2%. So now that's what we are trying to examine here. That cases where if there is a determination between parties of a particular charge, then how will we go about testing the eligibility? So if you go to the next slide, like I mentioned, we've tried to do a comparison between the GST methods, the transfer pricing methods, and the customs methods. This by itself is a 1 hour long topic, and I'm not going to go into great amount of detail because there will be interpretations after interpretations that we can draw. But on a plain vanilla basis, we know there are 4 methods available in GST: OMV, LKQ, 110% of cost, and residual method, which we referred in the previous case study. OMV is defined as the market value of supply of goods or services, means the full value in money by a person in a transaction where the supplier and recipient are not related and the price is a sole consideration, to obtain such supply at the same time when the supply is being made. So what price are you supplying to a third party is the price to be taken. LKQ means that the supply is made under similar circumstances in respect of quality, quantity, functional components, material, reputation. And it substantially resembles the original supply. Now, interestingly here, I would want you to note that the exception to related parties is not there in this definition. It's a point to be noted. It may become relevant in certain cases. Like for example, if Earth Limited was charging 2% royalty to all subsidiaries, can we press LKQ to say that that is really the model of the company? So it's not that nobody is being charged. Everybody is being charged wherever it is relevant, and it is equal 2%, right? So OMV requires a third-party reference. LKQ does not require a third-party reference. If we go to the transfer pricing methods that are available on the next slide, the transfer pricing methods are, we all know, different, but they can be linked in some way. So the transfer pricing methods are either transaction-based methods or profit-based methods. Transaction-based methods are comparable uncontrolled price, resale price, or cost plus. And your profit methods are profit split or TNMM. All these methods, there is obviously a science, and I'm no transfer pricing expert, but the science that we use to choose the best method. And it depends on various factors, not just the factor of getting the least profit or least margin in India, but also what is your situation, what is your arrangement, what is the nature of transaction, what is involved, is it goods or services? All of those factors determine what you will follow. Transfer pricing is linked to FAR analysis, function asset risk analysis, and it depends on what is the availability of data. If we have practiced in transfer pricing, we know that it's an extremely data hungry exercise. What is the comparability that you have of that data? So how do you remove the uncomparable elements from that data? And the possibility of making adjustments, like I said. One point I would want to make, like Vaidishwaran sir made, is that the aim of transfer pricing at the end of the day is to only reach reasonableness of profit. Why? Because therefore there is a reasonableness of the outcome tax, which is income tax. So the objective of all the effort of drafting, all the effort of the judicial guidance that we have is only driven for the net. The GST objective may not be entirely aligned to it, because the GST objective will be worried about the gross and not necessarily the net. So we need to keep that aspect in mind. And on the next slide, it will be very clear that when you look at the customs principles, as Vaiti sir was rightly saying, that customs obviously wants to increase our price and transfer pricing wants to reduce our price. And therefore, there is always this conflict. But leaving aside the conflict, if we look at the methods in customs, it talks about identical goods, similar goods, deductive value, computed value, and residual method. Okay. So transfer pricing also has the 5 different methods. TP had 6 methods that we saw. And now when you take the 4 methods of GST and the 5 methods of customs and the 6 methods of transfer pricing, you will get a nice, melange of things that you'll have to figure out what works best in which situation. But to my mind, when we see on the next slide, there is a fundamental, just one more slide. There is a fundamental string that we need to follow, which is that because transfer pricing focuses on net, it has profit-based methods, which may not be directly relevant for GST. So if we are trying to do benchmark analysis through transfer pricing, in my opinion, the transaction-based method, which is the CUP, RPM, CPM methods, are better methods to arrive at the solution that we are looking at, because there is 20 years of litigation in transfer pricing, 20 years of principles that are set, some beautiful guidelines available in the overseas publications that are available, which helps us present our case and determine our outcome. Also, TP has a very logical method of drawing comparables, of eliminating the non-comparables, of making adjustments, which will enable us to take a decision. From a customs perspective, the identical and similar goods valuation come the closest, but other methods may still be relevant because, and why are they relevant? Although they are not directly valuing the transaction, but they are ultimately trying to derive a value of the same transaction. So a deductive method or the computed method may operate, dehorse the time of import, but they are still focused on trying to get the value of the transaction of import. So many of the customs principles will help us in arriving at the value. Here we are talking of an intangible, we are talking of licensing of brand, we're talking of a service transaction, we're not talking of goods. What we are trying to leverage in customs and what we are trying to leverage in TP is guidance as to how should we go about dealing with a related party transaction. What principle should we apply? Like in the second case study, we saw that if there is a principle of benefit test, if there is a principle of limited risk distributor identified as not really requiring to pay for trademark, those aspects will help us in answering our questions. So in the same manner, for Moon Limited's question that whether the 2% royalty without domestic transfer pricing is sufficient and acceptable, we will have no choice but to go through a function asset risk analysis. We will have to leverage transfer pricing. We'll have to leverage customs and the principles that have come out on customs, and then try and see what is the closest outcome that we reach. We do not have, as we all know, any valuation rules in GST beyond the point to address this particular matter of, except for Rule 28 that we saw. There is no guidance document that is available of how you are going to derive the value of the transaction. So to conclude, in a transaction where related parties are involved and there is a brand or a trademark involved, if there is a charge, then we need to go through the methods to determine how should you value the charge independently and then compare with whether it aligns with any of the methods that we have. In the next case study, we are taking a case where there is no charge for the brand and what's going to happen. But before we go there, Vaidhi sir, your thoughts?
Well, it's a very interesting perspective on what happens in a domestic transaction or when both parties are involved in location, and you're forced to look at Rule 28 and not go beyond Rule 28. The larger legal question would be, is in the absence of any kind of notified methodology. For example, when transfer pricing came into the Indian statute, it was through a codified mechanism. Clearly came through legislation, and legislation had enabling powers, and through the enabling powers, the rules were framed, methods were determined, and methods were debated, methods were added. So it was a long story, as you said, 20 years, and enough jurisprudence and much more still awaiting. In that context, the Rule 28 is woefully inadequate, and the terms which have been used are very generalistic terms. Open market, that. And even there is even debate between Proviso 1 and Proviso 2 to 8 of the rulings. I would look at it this way: if it's a domestic transaction and the parties are related, how do you determine open market value? And in any guess could be wrong. Sense that I would benchmark myself against a particular competitive business, and some other person for the tax authorities could take a completely diverse view and say that I would benchmark against something else. Take the case of even a laptop. The margins can be very different from a trading perspective depending upon what kind of relationship. And these margins are also irrelevant at the point because the margins are always adjusted subsequently through incentives and credit notes at a later point of time. So compared to well-settled principles in international tax and reasonable guidelines from OECD on transfer pricing, which have laid down some kind of path. We still have phenomenal adjustment issues in transfer pricing. Domestic will be a huge challenge. And not only that, the jurisdiction of each state would determine the position. And therefore, one state tax authority could take a particular view, and that could litigate itself and land in terms elsewhere, and decisions could come from the court. And the landscape will be completely mired with litigation as to what is the. In fact, if you look at the contrast, had the goods landed from abroad and customs duty had been discharged, then the proviso to Section 5, when it seeks to levy IGST, takes you straight away to Section 12 of the Customs Act and the valuation through customs law. So it drags you through customs tariff act and valuation under customs law. Therefore, you have some kind of codified mechanism of identified goods and similar goods and things like that flowing. And for some of the participants who may not be very familiar with the customs because they may not have practiced that much in customs, it's a treatise to read what is an identical goods and what is similar goods. In fact, one of the brilliant conditions in identical goods is that it must be identical in all aspects and must be preferably manufactured from the same country of origin. And similar goods is something which is interesting, where it says that it is commercially interchangeable as a terminology that is used. So what is identical and what is similar? Let me tell you, there are not enough precedents in customs. More of whatever I know of prisons are at first level commissionaries where I won and cannot report it. But it has not traveled beyond significantly in terms of courts. So customs also, there are some WTO guidelines where the valuation rules were created. You see some kind of perspective as to what is the difference between identical goods and similar goods. But again, it is not so easy to draw that kind of a line between those two. Still, the valuation rules in customs are much more codified, and an import transaction probably stands on a better footing in valuation in a related party transaction compared to a domestic transaction where you're stuck with the terms which have to be redefined and understood. So going forward, one could probably take a stand. Because again, as a lawyer, I'll give you the stand that in the absence of effective methods clearly specified as to how to determine open market value, what kind of comparables can be used, what can be rejected, what is a margin that is permitted, whether you have a cost plus methodology that is permissible in certain situations. If and when do you eliminate one method to jump to the other method? These kind of guidelines are not clearly available. One can probably take a stand that the computation mechanism is not adequate. It would be probably a difference if you are faced with a large litigation. But I take the speaker's perspective that domestic transaction related parties are even more complicated. One thing that should be very clear is, are you related is also an important question. You need to go through the explanation in section 15. It's a very, very structured definition. And you may be surprised that you think that you're related, but you may not be related. Because the associated enterprise definition in transfer pricing is much, much more wider than the definition here. So you need to look at that completely in terms of companies under the same management, etc. Those are my thoughts.
Thank you, sir. Thank you very much. So moving on to the next case study, here is, like I mentioned, we are dealing with a situation where there is a trademark and there is no charge for the trademark. And this is an international transaction we are dealing with. When there is no charge for the trademark, clearly there's no transfer pricing available. And we are again saddled with the same question probably which we had in case study 2. So let's go through the facts. So Saturn US Limited is a global conglomerate. It's operating in 100 countries. It was established in 1920, so it's a 100-year-old company. It is one of the top financial services houses in the world. It has set up 3 subsidiaries in India about 20 years ago. It has a captive back office. So as you all understand, this is for outsourcing all their work globally, and would clearly be 100% exporting business from here. So as captive back office. It has an investment banking office in India. Investment banking, to clarify, would be an entity which is actively involved in providing financial services in the Indian market. In the subsequent slide, we've discussed more facts on what SIB does. And then you have the S Proprietary Trading Limited or SPT. And as the name suggests, this entity is doing proprietary trading. And again, to clarify, proprietary trading means that it has its own capital, whether it is equity or loans, and it is investing that capital for making trading profits. So these are the three businesses that Saturn US has set up in India. Now, there is no brand royalty charge to any of the subsidiaries in India. And more importantly, it is to none of the subsidiaries globally. So this conglomerate does not have a policy of charging for the trade name. Okay, let's go to the next slide. Now, the SCBO, which is the captive, the operations are completely captive. Captive meaning that there is only one customer, which is Saturn US's entities outside India. And they're all providing services back to Saturn US. So I am only a pure BPO, KPO type of operation. In case of Saturn Investment Banking, I have two kinds of business, ECM, DCM, and IB. ECM is equity capital markets, DCM is debt capital markets, and IB is investment banking. Essentially, what I'm doing is to give you an example of ECM, I will be, if there is an IPO or a follow-on public offering or a rights issue, you will need people who will run the issue, lead manage the issue, be book runners to the issue, or if there is a strategic sale of equity that somebody needs to do as a private placement, then you will need somebody who will broker the deal. DCM will be similar transactions for debt instruments, whether it's debentures or various corporate bonds. And investment banking will be transactions where you are advising on acquisition, sale, merger, demerger, valuations, and so on and so forth, right? So these are the activities. So most of the activities are market facing, and they are dealing with third parties. SPT is doing trading in permitted securities on its own account. Now, these three entities in India have asked us whether the same schedule on entry 4 will trouble them, and do they need to do anything about this? If we go to how should we now deal with this question in the following slides, the first entity, let's move to the next slide, please. The first entity is SCBO, and we know how to begin our analysis. We will, like we saw in case study 2, we will challenge whether there is a supply because we are saddled with schedule on entry 4. We debated that in the LRD model or the import and sell model, that I have to challenge the existence of supply. So in case of the captive entity, if all the services are provided back to Saturn US, and if there is no third party revenue that SCBO is able to generate in India because of the brand, then can we leverage the benefit test benefit test given by OECD to suggest that SCBO is not really getting any benefit of this brand? So I may be using the name Saturn, I may be using the logo of Saturn, which is a 100-year-old reputed company, in my name, in my stationery, in my offices. But what is the use of that brand? The entire revenue that I'm earning is to provide services back to the same brand. So am I deriving any disproportionate benefit because of the existence of the brand? The substantial answer, I am choosing the words carefully, the substantial answer is no, because my customer is the brand owner. My customer gives me work to be done, and I do that work and give it back. And so while I may be recognized as Saturn Captive Back Office India Limited, I am bearing the name Saturn and bearing the brand name of Saturn only because I am the child of my parent. So like a parent gives his name to the child, the Saturn US Limited has given its name to SCBO in this case. I chose to use the word substantially because there is a bit of a gray which certainly can be debated against. The bit of a gray here is that if I need to hire the best talent to do this work, okay, then probably if I am Saturn captive back office, I have a better chance than if I was a non-branded captive setup. I have a better chance of getting the right people. I have a better chance of, making sure that I am able to present myself in places or get invites to places on recruitment which are not inviting everybody. Correct. So that may be a difference, but the counter argument to that could be that that is the recognition of the name, but is this the primary activity that I'm in as Saturn captive back office? The primary activity is to receive, let's say, working papers or documents or scanned documents or data, cleaning that up, formatting it, putting it in the analytical manner that was required to be put, and sending it back. That's really the primary revenue generating activity that I'm doing. My association to a name can always have intangible benefits, or for that matter, intangible uh, risks, right? But there is otherwise an infinite amount of possibility of arguing that there is either a benefit or not benefit. So OECD also beautifully brings out, and which will be very relevant when we analyze for investment banking, that you should not only look at benefit, you should also look at cost. So is the provider incurring a cost, and is the recipient getting a benefit? And we'll discuss this again when we come next. But my summary analysis is that if you're a captive business, in my opinion, you have a good case to argue that you are not leveraging the brand, and Schedule 1, Entry 4 should not trouble you. When we go to the next item, facts may become a little more interesting. So if we go to the next slide, on the next slide, we are dealing with the investment banking entity. Now we looked at what investment banking is doing. It is doing ECM, DCM, and IB activities. And all these activities are market facing. You're dealing with third parties, right? In a activity like this, there will certainly be, and I gave you several examples. Let us say I'm managing a very large public issue. I'm managing a private placement. I'm trying to get investors for somebody. The nature of business is reasonably suggestive of the fact that the SIB entity will be identifying itself and leveraging the global presence and experience to its advantage. This is clearly a question of fact. It needs to be determined on a case-by-case basis. My experience in activities like investment banking is that certainly the India presence may be leveraging the global recognition that the brand has, the global experience that the brand has to its advantage. In fact, I came across a very interesting public issue document which laid down a eligibility criteria for the bidders. And the eligibility criteria said that you need to have an office in Hong Kong, Singapore, Dubai, and New York, and that you need to give us copies of mandate letters of having done similar work in those countries to be able to qualify to bid for this project. Okay. Now, those are compelling evidences of the fact that there is certainly an advantage that I'm deriving because of the global presence, because of the global brand, because the brand has done successfully in so many countries. So in situations where the entity in India is market facing and the entity in India is earning third party revenues, it becomes incumbent on all of us to really analyze and determine whether there is an existence of a supply and whether Schedule 1 Entry 4 will apply. Of course, Vaidishwaran sir has given us the argument around Section 9 read with Section 15. But In addition to that, if we are trying to determine what is our real risk, if there is a transaction where I am market facing, I am earning revenues from third party customers, I am possibly one of the cases which needs to be tested. And the test certainly has to be looking at, am I getting a disproportionate advantage because I'm associated to a brand as compared to the fact that any other third person would have been in my case. This valuation, we talked about valuation methods. Vaidhi sir also gave his point of view, is going to be a complex exercise, and I'm not again repeating the valuation point. But I want to mention the fact that some of this can have a domino on your transfer pricing as well. And why do I say that? If you're in any of the profit-based methods in transfer pricing, let's say you are on TNMM, which is transaction net margin method. What you're doing in TNMM is you are basically saying that at the end of the day, whatever profit I'm making is sufficient, and it therefore I can use cost plus comparables to say that I'm effectively satisfying the amount of profit I should have earned in India and paid tax on. If you are in a method like that, like TNMM, then any increase in expenditure, which is this royalty that you may admit for GST purposes, will result in a need to earn a transfer pricing margin also on that expenditure. Because certainly your overall margin on a net basis will fall if you add this notional expenditure after a complex valuation exercise that you've gone through. And therefore, there will be a domino impact possibly on transfer pricing. There is certainly an argument to be analyzed that this is a deeming fiction under law, which is restricted to GST law. If there is a deeming fiction under particular law, and I value the transaction, let's say for simplicity's sake, as 1 crore rupees, and I pay 18 lakhs as GST, I'm certainly not going to remit 1 crores to Saturn US because Saturn US is not charging me for it. I am self-assessing a deemed value of 1 crore after a lot of research and analysis and advice. And I'm self-assessing 18 lakhs to be paid. I'm paying that 18 lakhs, and then it goes into my credit pool depending on taxable, exempt, etc., etc. That activity is entirely done because of the law of GST, and it has nothing to do with transfer pricing. We have looked at this fairly closely, and at least in my opinion, whatever I have been able to go through in transfer pricing, to my mind, it's not a very simple answer to say that because it's a deeming fiction and GST, it does not affect transfer pricing. Because transfer pricing is trying to derive in the profit-based methods in net margin. And there, if you saw what we saw in transfer pricing, you do adjustments for the non-comparable items. You remove and add things. This element will certainly become an element which will impact your ability to say that there is no risk in transfer pricing. Let us just do something notionally for GST. So before you take a call on GST on any such matters, you will have to weigh in whether it affects your transfer pricing. When we go to the third entity, which is the proprietary trading entity, there the answer to my mind is reasonably simple. The purpose of putting this third entity was this entity is also market facing, correct? This entity is not captive. This entity is also market facing. And therefore, like SIB, like the second entity, is there a risk in SPT? In my opinion, there is limited risk in SPT because SPT is basically doing investing activities. SPT may be dealing with third parties. SPT may be buying corporate bonds. SPT may be buying government securities. SPT may be trading on the exchange. But all the activities are driven by investing the power of capital and research and analysis that you have, and not really earning anything from the third party. Your entire earning is linked to your ability to make profit on the transaction. So to that extent, you're not getting any security cheaper, or you're not getting any extra dividend, or you're not getting any extra interest because you're investing from the Saturn brand, right? You will earn the same thing as any other trader would earn, whether he's Saturn or he's not Saturn. to that extent, there is certainly a powerful argument to say that I'm not comparable to SIB. I am primarily engaged in making money on trading transactions. Yes, I may have some knowledge that I may get from my parent, but that is not brand. That is not an intellectual property right that I'm exploiting. My exploitation is more about my skill of my people that I've employed locally, because I need to have traders locally sitting here doing the transaction at the right time, buying at the right time, selling at the right time. Nobody sitting there is making that decision for me. Unless I do that, I don't make money. And therefore, in SPT's case, we have a good case to argue that there is no leveraging of the trademark. It is only in the SIB case that and comparable cases like that, which are market facing, we need to think through how do we value it and what is the domino of that on transfer pricing.
Question and multiple perspectives flowing from that question, and really well structured factual matters. I agree with you on the first point where you talked about the captive segment, where there is no market interface, there's no third-party interface, and the entire work is done only for Saturn. And hence, the brand leveraging doesn't exist, and brand usage is totally irrelevant. Assuming the revenue takes a stand, that brand is still relevant because the brand is still displayed and brand all documentation continue to use the brand. One possible answer could be, if it has to be contested, is that for the captive effort done or the captive work done by the Indian entity, it would have been remunerated by the foreign company, and that would have been reflected as an export of service. And therefore, there is a pricing mechanism through which the exports are determined. If there is any view that the pricing has been influenced by the brand being made available, and hence, therefore, price is no longer the sole consideration. At best, the imputed value towards the brand usage can only be added to the export value from a transactional value perspective, and it would still not be taxed. Then the larger question is, can you still insist on a reverse charge mechanism for that purposes when the ultimate transaction is export? And we can go back to various other arguments around that. Going to the second segment in your question, that's a very interesting question where third parties are involved, and as you rightly said, the brand plays a very big role. Leveraging happens, and therefore is consideration imputed to the parties. If consideration is not contemplated, if for some kind of royalty for the brand can be identified. Well, it will be a tough call if you are going to advise post-transaction. But if it's going to be a pre-transaction, it's very well within the professional's responsibility to flag this issue and contemplate a royalty payment. In fact, slightly digressing, post-COVID, you have new scenarios coming up. One particular scenario in post-COVID is that there is one group company which has got excess production because it is falling in a zone where it's permitted to manufacture. But it is not able to move anywhere because the other zones are containment zones, and stock keeping is a problem. So it came with a simple idea to me saying that, sir, my another group has got space, so just keep it there for some time. His question was very harmless. His question was, so what does the documentation need for moving the goods? My larger question was, being related parties, what is your transaction between? Why is he allowing it to use? Is there a consideration which you have contemplated? If you have not contemplated, then the Tata Sons story can always come back to you. The various judgments for the Bombay High Court can always come back. So it is better that even between group concerns, if you're going to ensure that you're getting a benefit or a service or some benefit from a group entity, document it and identify a consideration which at least matches to some extent the commercial reality. To ensure that your input tax credit is flowing, so it's a tax neutral exercise. In case you have not done that and you fall in the scenario of second scenario which are pointed out. If it's a post-transaction and you have to defend it, then the only argument would be revenue neutrality. Say that if you still insist that I should pay GST on the royalty, I would anyway got the credit and I would have used it against the value which I've built my third party. To some extent, it is revenue neutrality, though it has to be tested from a GST perspective, unlike what we used to do in the pre-GST era. Here again, there could be post-COVID issues where royalty is payable under the agreement, but the foreign company decides to waive the royalty. Foreign company says that we understand your problems, you don't have the money, therefore you don't have to pay, or you make a provision in your books as on 31/3/2020, and the payment is deferred. And what is the sanctity of that provision? Whether your associate enterprises can trigger in and time of supply can trigger in. So royalty has got its own huge ramifications post-COVID. So when royalty is agreed and contemplated, we can have so many ramifications. Imagine if royalty is not agreed and contemplated. Good question and good answer. Please proceed.
Thank you so much, sir. So now we move to the final case study. Now this, like I said, may be a case study which may not be, as a part of our regular work, but certainly probably the most complex question that we will look at today. It is 3 case studies interweaved into one that I have tried to do. It is slightly longish discussion. I think we have about half an hour, which should be enough, or about 20-25 minutes, which should be enough to cover this matter. The facts before us is a Neptune Singapore Limited, which is the owner of the.
Devesh, sorry to intervene. See if you can finish it in 15 to 17 minutes so that some questions from the audience are also.
Agree, sir. Agree. Yes, I will do that. So the facts are that Neptune Singapore is the owner of this brand, which is a very successful brand in the foods business. Uranus India is a distributor of this brand in India and is importing and selling these products, and again, very, very successful in India. Now, Uranus wants to buy this brand from Singapore. And the consideration right now being discussed is 500 crores. So it's a large transaction. There will be a deed of assignment, and the deed of assignment will be signed in Singapore. And Uranus is based in Maharashtra. Now, the question that Uranus has asked us is that, is there GST required to be paid under this in this transaction? Will reverse charge apply? What should be the fact pattern? I've also created 2 variations of this, which are fairly intertwined, linked, and the analysis remains fairly similar. Would it make a difference if Neptune was in Tamil Nadu, right? And therefore, whether it's a transaction now for an entity in Tamil Nadu, selling it to an entity in Maharashtra? And then would it make a difference if the acquisition was made by Uranus Netherlands instead of Uranus India, while the entity is Neptune Tamil Nadu? So what we are trying to cover is import transaction in the base case study. We're trying to cover domestic transaction in case study 5A, and we are trying to cover possibly export transaction in 5B. So I'm using word import, export very, very colloquially. We will have to find out whether it's really import or export or not. So when we go to the analysis around the facts on the next few slides, we will not get into the discussion on whether intellectual property and trademark is goods, movable property. I think we have enough discussion on that. There are many rulings. But in the interest of time, we focus on how are we going to deal with the taxability. So we've looked at case study 1 and we know assignment is goods. So let us again not get into the discussion of whether it's a service. So we left case study 1 by saying that the big question is place of supply. So in a transaction where a Singapore entity is selling to a Maharashtra entity, what really is the place of supply? Okay. And that place of supply is going to determine that whether that supply is going to be taxable in India. Very importantly, in this case, we are dealing with goods. We are not dealing with services because it's an assignment. So therefore, an additional angle that will come in, which does not exist in case of services, is that there is no possibility of reverse charge in this case. So how would tax be paid if this is really an import transaction? Is another question we need to think of, right? So in the erstwhile VAT regime, we had section 4 of CST Act, which said what is sale within the state, sale outside the state. And they were all linked to movement, correct? Because they said that if the sale occasions movement from one state to another, that's an interstate sale. Otherwise, it's a local sale. the question of movement in intangibles does not arise. And therefore, the question of how this same transaction would have been treated in VAT regime is equally important. And there are some precedents that we look at on how courts have looked at VAT taxability on the movement of or the taxability of intangible transactions. But the first very interesting case that came about, which is Delhi High Court judgment, which is currently pending in the Supreme Court, is on the next slide, is the judgment in the case of CUB Pty Limited, or which is a 2016 judgment admitted in Supreme Court in November 2019. And this is a very direct case law which helps us. It sets a strong precedent, and there is a lot of leveraging that has been done on this decision. Let us understand the facts. The facts are that Foster's, which is a very popular beverage brand, was acquired by Sab Miller. Foster's Australia was the owner of the intellectual property that is involved, and there were several intellectual properties involved, all trademarks. There was an ISPA signed, India Sale and Purchase Agreement. This was executed in Australia, and all the brands were transferred to Skol Beverages Limited. And there was certainly a Foster's India operation before that, before the transaction had taken place. So Foster's India, which operated for 10 plus years in India before the transaction, had the license to use some of these big brands, which are big in India. And this license was terminated just before the ISPA. So Foster's Australia had given a license to use the brand to Foster's India. Foster's India, under the licensing arrangement, was obviously then bottling and selling the products. This licensing arrangement was terminated just before this ISPA was signed to transfer it to Skol Beverages. The question that was being examined for income tax purposes is that, is this a transaction on which Foster's Australia needs to pay tax in India? Now, there were various arguments that were presented by both sides and fairly interesting. The first question that the court was trying to examine is, where is this income arising? Because you have to, from an income tax section 9 perspective, you need to decide where the income is arising. And the income arising question led to the question of, where is the situs of this transaction? Where has the transaction taken place? Now we know we are dealing with intangibles. We know that we are trying to fix situs to an intangible. Okay. And so is a question which is close to being a quandary of trying to find a physicality to something which is intangible, because you're trying to find some sort of nexus to a place for a particular intangible, where such nexus is very hard to represent, given the fact that it by itself is intangible and cannot have any physical presence. And that really was the big analytical question that the court looked at. What was argued was that the origin of the brand is in Australia. There are 100 countries that are looking at it. If you start looking at taxing the transaction in India, then every of these 100 countries will want to look at their transaction separately. You cannot really measure this transaction into 100 different segments and so on and so forth. These are the arguments of the taxpayer. The taxpayer also made a very compelling argument to say that, given the intangible nature, from a situs perspective, the only way a situs can be determined is where the owner is, because the intangible belongs to an owner. It is a property, no doubt. It is a property driven by ownership, no doubt. And therefore, the location of the property is where the owner is. And therefore, the situs of the transaction is where the owner is, and the owner sold it. And therefore, from a Section 9 income arising perspective, the income does not arise in India because it arose in Australia. What the revenue try to argue is that the Foster's brand has been in existence for a long time. It is registered in India. If it was not registered, you could not have used the brand. You have created a value to the brand by contributing and accreting to the Foster's brand in India. And therefore, there is certainly a value to be taxed in India. The revenues also took an alternate plea. So it, of course, took a main plea to say that it has business in India. But it also took an alternate plea to say that if there are India-specific brands, or if there are any global brands which have an Indian market, then a portion of this income should be attributed and at least some portion should be taxed in India. If you go to the next slide, the court actually did not appreciate most of these arguments. The court examined, and this was the time when that famous retrospective amendment happened in 911 from 1st April 1962. The court examined that amendment, and that amendment basically said that if you have a transaction in securities where you are selling the securities, but the securities derive an underlying value directly or indirectly from assets substantially located in India, then the transaction is taxable in India. So the court held that for shares and securities, if you have made a specific provision that they will be taxed if the value is derived from India for assets located in India, and if you have not made a specific provision for intellectual property, then these principles cannot be applied. And therefore, then there is no other way to determine the situs but the location of the seller or the location of the owner. The court relied on the principle of mobilia sequuntur personam, which basically says that the property of an individual is most appropriately located where the individual is located. And therefore, that's really the principle that got established with this case. And the decision was, it was an advance, it was an AR which went against the Delhi High Court held in favor of Foster. And the decision was that no income can be taxed in India. As I said, the matter is pending in Supreme Court. But I did mention that there are VAT rulings as well. So if we go to the next slide, let us also examine how VAT has looked at it. Now, there was this famous Monsanto and Subway case, which we are aware of. And in that case, while the title is Monsanto, but these are facts related to Subway. In that case, Subway had licensed the brand to various licensees in Maharashtra. And because Maharashtra schedule had franchise as an entry, Maharashtra VAT was sought to be levied. Now, the court went on in a great amount of detail to examine whether this transaction is covered under 366(29)A, and concluded that this is not covered under 366(29)A because there is no transfer of right to use. It is a permission to use the brand and the franchise. And it gets terminated and taken away with very limited or no rights to the franchisee. But it did then go on to talk about the situs of the transaction. And it did say that although we are saying that this is a transaction which is not a transaction which is that of sale liable to VAT, it said in any event, had it fallen for decision, we would have been inclined to accept the argument that the situs of such agreement was executed in Delhi. Why? Because Subway was based in Delhi and would not be Maharashtra, but in Delhi. While considering tangible assets, there is no doubt as to where the situs is. It is where the goods are physically located. But for an intangible asset, which does not have physical form or existence in physical location, the legislature could have, by some appropriate deeming fiction, expressly provided for situs. That has not been done, and therefore the principle of mobilia sequuntur will apply, and therefore the transaction situs is in Delhi. Very, very interesting, somewhere endorsing the judgment of the Delhi High Court saying that intangible is located where the owner is. Here, the additional interesting aspect is this was a licensing transaction. This was not a assignment transaction. If we go to the next slide, this is a slightly contra view that was expressed. This is a Maharashtra tribunal view. In the case of Dufar Interfran, this is still pending in the Bombay High Court. I will not spend too much time on this in the interest of time, but here the question was that that the brand that was sold by an Indian company to a UK company, where is the situs? And the arguments that were made by the taxpayer was this is under 20th century, and therefore it should be where the agreement is signed, which was signed in UK, or that it should be granted export status because there was a circular which suggested that. The ruling was finally, the tribunal ruling on the next slide was linked to registration. And the tribunal said that because the trademark is registered in Maharashtra and continue to be registered in Maharashtra or in Mumbai, even after the sale, there is no question of any export. The trademark is not moving. Okay. Registration is the only thing that protects the trademark. And therefore, registration is the test of determining what the situs of the transaction is. The reason why I said it's slightly contrary is that while the outcome in this particular case is exactly similar to the Foster's case, the emphasis of this case is entirely on registration. And it ignores the fact that the owner, it does not discuss the owner location, and it does not discuss the place of execution of the contract. So while incidentally the outcomes have been the same, but if this was a reverse transaction or if this was a Foster's kind of transaction, the outcome could have been different, because certainly the Foster's brands were registered in India, and therefore if this same Dufar principle was applied, then they would have suggested that this transaction is liable to VAT. The next case, which I think is the last relevant case for us to look at, is the Lal Products case. Now, this is important. First, it certainly goes and follows the CUBPTY judgment, and it says we will have to follow the mobilia principle. The reason why I'm highlighting this case is that it presents a slightly interesting analysis. The facts are that there is a company, Oriental, based in Kerala, which is transferring a brand to Marico, based in Bombay. And the question, which is the second bullet on your slide, the question was that, okay, if the situs is now Kerala because of the mobilia principle, is this a local supply or an interstate supply? And the court has analyzed and concluded that this becomes an interstate supply because the owner, Oriental, was in Kerala and the buyer, Marico, is in Maharashtra. And therefore, following the mobilia principle, the intangible has moved from Kerala to Maharashtra. And therefore, this becomes an interstate supply liable to CST and not liable to local Kerala tax. So this ruling is suggesting that the intangible has moved from one state to another because the location of the owners for the intellectual property has changed. Point that we need to note, this matter is again in appeal and we'll see what is the outcome, but it's an important fact. Next. So now with all of this, how do we conclude? We can skip this slide. We've covered most of the points. If you have to conclude from a GST standpoint, we do not have, like service tax, that the transaction has to be within the taxable territory, which was there in the charging section in GST. But when we read the construction of section 1, we read the place of supply rules, we can conclude that the situs still will have to be established as within India, and only then we will determine whether it's taxable and liable to GST. Next slide. So if this was a domestic transaction, the VAT principle said sale occasioning movement. Okay, but the GST principles add one more angle. The GST principle says that in 10.1, if you see, it says that there has to be a movement for delivery. So the word delivery has been added under GST, which was not there in the VAT laws. So VAT law said sale occasioning movement. The GST law says it involves movement for delivery. There is no question of any delivery that can happen for intangibles. So although in Lal Products case, we have a judgment of the Kerala High Court which says that there is an occasioning of movement from Kerala to Maharashtra, because there is no delivery possible in case of intangibles. From a GST standpoint, one needs to not directly follow Lal Products because of the fact that there is no delivery possible. If no delivery is possible, then whether 10(1)A will apply, which is the movement linked clause, which will make it an interstate supply in our fact pattern, or whether 10(1)C will apply. 10(1)C says that where there is no movement, you follow 10(1)C. Next slide, please. So if you go by 10(1)C, then clearly the tax that will be applied is CGST, SGST. It will be a challenge for the buyer to take credit because he may not be located in the same state. It also means that exports may not be possible because if you follow the mobilia principle and you follow 10(1)C, then the situs is in India when the transfer is happening, and therefore there is a concern that whether you will be able to claim an export benefit. But at the same time, you can also argue in the import transaction where we said that there is a Singapore entity trying to sell something to an India entity, then there is no question of any tax on those transactions as well. Because if the principle is that the situs is where the owner is located and the owner is outside India, Singapore in our example, then the transaction should not be taxed. Of course, there is this is an ambiguous situation where 10(1)C and 10(1)A both are a challenge. The machinery provision has not factored in any specific provision for intangibles. There is a section 10(2) which says that where there is no machinery provision, the government can prescribe a machinery provision. I don't know whether they will use 10(2) to prescribe, because we have seen some major transactions that have happened in intellectual property recently, and there has already been controversy which is reported in the press on some of those transactions. So whether 10(2) will be invoked, I'm not sure, but in the current law, it seems that 10(1)C probably may be the closest approximate for us to take a decision on the taxability. So therefore, if we move forward, I'm sorry, I think we are exceeding time, but if we can continue with the permission for another 5-7 minutes, I think we'll finish.
I'm okay. Pranav, it's fine?
Yes, sir.
Okay.
Yes, sir.
Okay. Thank you. Thank you.
Very interesting talk. Please continue.
Thank you. Thank you. Now, we looked at domestic transactions. Now, when we look at international transactions, it is an equally interesting aspect. While we looked at some conclusions before, question is that do you really go only by the mobilia principle, or do we have to evaluate section 11? Section 11 relates to import. It says an import we know is defined as bringing into India from a place outside India. An export is defined as taking to a place outside India. Is this possible in intangibles? Will the Lal product principle be applied? Because here import and export does not link anything to delivery. So if the Lal product principle is applied, then certainly there is movement of intangible which is possible. If that principle is upheld by the Supreme Court, then section 11 can become a problem for us. And if section 11 becomes a problem and there is indeed a movement possible which becomes an import transaction, then the arguments that we set out in section 10 linked to delivery are no longer relevant. Import is taxable if it is bringing from outside India to a place in India. If you go to the next slide. So therefore, if we have to apply IGST on imports, again, there are several hurdles that we come. The first is that we have to look at the Customs Tariff Act 1975 for determining classification. That is what the guidance is to us. That is what is there in the notification and the law. There is no entry for trademark in Customs Tariff Act, right? So if there is no entry, then can it really be taxed? Second is that will this the rate notification does not have a residual entry in customs, and therefore is there a lack of competence to tax because there is no taxing entry, there is no rate, or will it fall in the residual rate? And if the rate prescribed for permanent transfer is 12%, then how do you interlink all these inconsistencies to decide the tax on imports? Thirdly, if there is an intangible import that happens, then the customs law does not apply on intangibles as per the GATT convention, which is now the WTO convention. So how will you really apply the customs law in case of intangible import? There is no physical media that you can get your brand on. On the next slide, does therefore the importer have to file a bill of entry to say that, okay, I have imported this, it is intangible, and therefore to comply with the law, because there is now movement possible, I am going to offer this to tax and pay tax. And why will the importer do this? The importer will do this to avoid litigation, because if he is otherwise able to take credit, does it make sense for him to take the mobilia principle? And because as I said, if you follow the mobilia principle, how will Indian regulators go and challenge the seller? Because there will be a jurisdiction problem here of how is the jurisdiction of India extending to force a foreign party to take registration in India and pay tax on a transaction on the basis of whether, in their view, because it is registered in India, it is taxable in India, like the Dufar case. So to my mind, and then I think if we see the next slide is again on exports. It has the same kind of controversy. So to conclude on this, to my mind, we have very limited guidance overall available on taxing intangibles. It remains a challenge. Even globally, there have been several cases that I came across where the dust on this issue is not settled. But probably the most appropriate technical view in this case is to follow the ownership principle, because of the fundamental logical explanation that there cannot be a physical location attached to an intangible property. And therefore, I find significant force in the principle, whether I go by a legal maxim or I don't. I find it significantly forceful to say that the intangible exists where the owner is. If that is the case, then in the import transaction, in my view, the foreign party need not pay any tax because these are goods, clearly reverse charge cannot be paid. In the local transaction, in my view, again, there cannot be any delivery, and therefore you will have to pay CGST, SGST in the current owner's state. And in the export transaction, unfortunately, you will not be able to claim export because the owner is in India, and therefore it becomes a local transaction again. This is clearly unsettled, as you saw in income tax, in VAT, and internationally. So right now, I think we can only take the most plausible views, and then we have to track this very, very closely to see how it evolves. These are certainly very, very complex technical interpretations, and we'll have to make sure that we are sufficiently covered, like Vaiti sir said, in the inception stage itself, in the transaction structuring itself, to make sure that we minimized the risk and paid the right kind of tax with the least chance of litigation.
Thank you, Devesh. I'll just take 2 minutes on this case study before I hand it over to Pranav to open up the chat box. Take a few questions for the to answer. This is one of the most complex case studies, and it involves multiple dimensions, probably ideal in an RRC kind of scenario where people have debated in studies and come to views. but in the virtual platform, we'll try to see what can be done. I would give three dimensions to it. Number one would be in the context of what he uh, mentioned towards the last part of the session, where he referred to the international principles on intangibles and the WTO principles on transactions which may not involve the customs borders or the customs station. So there could be a trademark which is assigned, and or let us, for the purpose of limited purpose, also talk about a license. So let us say that comes through a web format, a downloadable format, in some kind of format it comes to you. You get access to drawings, download, or whatever. Now, in that kind of a scenario, if customs is getting ruled out on the ground that import has not happened through, and there is no concept of a bill of entry and no levy of customs duty as intangibles, then if the levy under Section 12 does not happen, can the levy of IGST on imported goods happen? Here again, the distinction between assignment and licensing will come into play. So if you treat it as an assignment, and if you treat it as a transaction involving goods, and if these goods have happened through an intangible format which does not physically touch the customs station, can you then not take a position that even IGST is not applicable because custom duty is also not applicable? Now, that is going to be another segment itself, and this will be more popular in another topic of software, especially copyrights. The delegates, I mean, the people who are attending the seminar can also look at a decision of the tribunal in the case of Atul Kaushik, where the tribunal has Justice Kodar Aguram has elaborated on this point, where he said that you cannot levy a customs duty because there is no competition mechanism that exists for taxing an intangible because the import does not take. That's the first dimension. The second dimension is the speaker brought out this brilliant concept of how the word delivery has suddenly found place in Section 10 and that was missing in the VAT regime. Delivery is a very critical point in Section 10.1 and the way it is structured. So, is there a possibility of a deemed delivery? Is there a possibility of a symbolic delivery? Is there a possibility of a fiction by way of a delivery? Well, there are answers in the sense that if you can go back in terms of reading, if you look at the decision of the Karnataka High Court, the case of IBEX, the Karnataka High Court has recognized the concept of a symbolic delivery or a team delivery. That also probably resonates with the Mobilia principles which we talked about. We're talking about ownership following the trademark. The delivery is also happening in the same state, but through some kind of symbolic method. Because all these are open, none of them are tested. Whether the word delivery would be interpreted by the courts to cover symbolic, or the courts might say, in the absence of any specific language, the court is not willing to put any more language into it than delivery, and delivery can be only seen as actual delivery, and trademarks are not deliverable. So that could also be view of the court. So we do not know what kind of jurisprudence will evolve on this, but that's an interesting dimension to look at. The third interesting dimension, which I thought the people, delegates can look at is, if you can get a chance, read the latest Supreme Court judgment in the case of Great Eastern Shipping. And that was a dispute in the context of how a charter party agreement should be viewed, and whether a charter party agreement involves a transfer of right to use goods in terms of Article 36.9a. There, the Supreme Court goes on to observe, by referring to 20th century finance, and they go on to observe that the situs of the agreement plays a very important role. And somewhere they've gone back to the principle of situs of the agreement, and they say that if the agreement is signed in a particular state, in the case it was in Karnataka, the state of Karnataka has got every right to impose sales tax on this transaction. But the larger question was whether which state having closer proximity to the territorial waters can tax the transaction. It was a larger question, but that was sidestepped in the context of the fact that the Supreme Court ruled the agreement is enough and the situs of the agreement is enough to create some kind of liability. You can also look at the decision of the Gujarat High Court in the case of Ambalal Sarabhai, where there is a deed of assignment of trademark, and that deed of assignment was executed in the state of Maharashtra. The Gujarat High Court said that there is no legal fiction in the Gujarat VAT law to create a situs in this format. Therefore, since the situs is in Maharashtra, this whole thing cannot be taxed. So we have very number of interesting principles, interesting precedents in the pre-GST regime, which will have a major role. And as the speaker rightly pointed out, the CUB judgment is a very important judgment. It has very good read in the context of how the trademark has to be looked at. trademark itself is an ocean of knowledge, and like people, the tax angle is only one element of it. Trademark itself has got much more dimensions into it. And in fact, there are issues now going on in the world as to which court has jurisdiction for a trademark dispute. For example, whether a website server can be the basis for a jurisdiction location. There are precedents on that count. So if that is the case, all those judgments can also throw light on from a taxability perspective, and for domestic transaction, it can be a different light. So I thank the speaker for his wonderful presentation of all the case studies, his insightful analysis, and each conclusion for every case study was well structured. He presented his views very well. I congratulate the speaker for his effort, and I hand over the proceedings to Pranav for.
Thank you. Thank you, Divyesh Bhai and Vaitishwaran sir. I think it was a marvelous exposition on this intellectual property rights. A very interesting session. Very nicely taking us through all the provisions of the Act and various judgments, and the case studies with the various data information in them were also very important. Also, he has linked to the various transfer pricing provisions and the judgments under the VAT laws and the erstwhile service tax laws also. So a very interesting session by Divyesh Bhai. Thank you very much, Divyesh Bhai. We have time for some questions. We can take them. Sir, it will be there in your chat box also.
Pranav, I have seen some of the questions. So yeah,
will you take
just pick some of those?
Yeah, sure, you can.
Yeah, because some of them have already been answered. In fact, there are a few questions around situs of leasing transactions. And Vaidhi sir has just answered that question in the Great Eastern shipping point that he mentioned, that somewhere Supreme Court has again concurred with the analysis presented in 20th century finance case in the year 2000, that the only way to determine situs for such transactions has to be where the agreement is entered. Of course, I will, my personal view is that in addition to the agreement, certainly facts will have to be looked at because the mobilia principle is equally relevant. Because as an owner, I am licensing an intellectual property or intangible property and not a tangible property. And Great Eastern Shipping again continues to be a conversation on tangible property, but when intangible property is involved, I will have the additional angle of where the owner is located to be looked at, so that if there is an artificially structured transaction where A of Mumbai is selling something to B of Pune and we travel to Singapore and do the transaction of leasing and claim the 20th century benefit, then it may be a stretched interpretation of 20th century. So when IP is involved, I think the additional aspect of making sure that we've very well tested the principle of the Foster's case, even for licensing transactions, and not blindly rely on 20th century is very important.
Right.
There are a few questions around the rate of tax on licensing of intellectual property that remains 12%, like we saw for goods and services, the rate is 12. So as long as there is licensing involved, it will remain 12%. It does not become 18%. A few questions on the case study where we talked about the import and sell versus assemble and sell and royalty. I think it's a good thought being put together to say that if I can demonstrate in the value of the parts itself a royalty was embedded, then do I need to attribute anything further to value? It is certainly going to be a question of facts and determination. If we are able to determine that I am paying a higher value to the parts, which is an embedded royalty, and I'm paying a royalty on the parts, then yes. But if this is a royalty that you're paying for use of the trade name, which is unconnected to the item that is imported, then we will have to examine and determine whether you need to attribute a value or you need to test the 2% as we were looking at in our case. sorry, I'm just scrolling through the questions. Yeah, there are a few questions on the classification valuation that we discussed between goods and services and the flaws in CPC. I entirely agree that, as Vaiti sir rightly pointed out, that it has been a direct reference to an annexure without really spending qualitative time, like we have constructed over a number of years the Customs Tariff Act or the Excise Tariff Act, and it will bring in its own set of limitations. So whenever we are referring to the CPC, I think there has to be reasonable amount of caution, and also understand the background of each of these entries. There are more and more guidelines that are available beyond these entries that we saw, and they need to be examined. And as the question rightly points out, there is some provisional list and there is a final list which are borrowed. So again, there are differences between the two, and in each of the facts we will have to check what is the most applicable case. Right. One of our members has rightly pointed out that there is an ECJ judgment saying that TP principles cannot be directly applied to VAT. And I fully agree with you, which is why we were trying to draw a comparison between methods of TP and methods of VAT. That all TP methods do not directly work for VAT purposes. But if transfer pricing was, let's say, it was a comparable uncontrolled price method, and you had a comparable price to a third party from the same supplier, then you could have had a lot of similarity with what open market value method is. So the idea is to not reinvent the wheel in trying to find all your comparables. The idea is to leverage what TP has done, find out whether it connects back with what is relevant for you. And if it does not, then yes, you will have to do your deep dive again. And again, like Vaiti sir said, you are trying to find your way with very, very limited guidance available. So yeah, I'm just checking if there is any other question.
So transfer pricing can be supportive in these cases and not can be directly be taken. That is what is.
Yes. There is a question, there is a comment on the Dempe principle and post-BEPS era. I understand, I mean, while I shouldn't say I understand because I'm not an expert around transfer pricing, but I think if you look at it, the whole objective of BEPS, or the whole objective of how you are internationally cooperating, is to again try to determine how should we share the pie. It is not vitiating the principle of CITES. It is not vitiating the principle of where the intellectual property is located. We are trying to find out where the intellectual property is located. We're not trying to find out where the fair share of tax should be paid. So there is a difference between the two, I feel. And yes, one could argue, and I have not put that out because we didn't have enough time, but one could argue that the owner itself is different. Right, so the person who is the IP holding entity may not really be the substantial owner, but the owner is somebody else who has really built and curated the brand, and really he's the owner of the IP. Yes, that could result in a different outcome from a CITES perspective and a different outcome from tax perspective. But again, those are extremely, extremely fact-driven questions. Just because I have spent money to grow somebody else's brand does not make me an owner. So there is a concept of economic ownership in income tax, but we don't have any such concept in GST as yet. So we are going by legal ownership, and to that extent, there will be that difference between how income tax treats this transaction. We only have to try and leverage if it gives us clarity of determination of what the CITES is.
So he has also replied that Dempe changes the owner and thereby changing the sharing.
Exactly. So therefore, the point is that it's more about, again, chase the owner and get a fair share of tax.
Right.
Yeah, status of ownership linked to 75C, I'm not so sure because 75C is unlikely to determine situs. It is only saying that if if you can't tax a transaction anywhere, then it is deemed to be an interstate supply. So I think the question of ownership is still a very legal, sacrosanct question. It's independent of the provisions that we have.
Divesh bhai, this the point which you had raised regarding 10(1)(a) and 10(1)(c).
Yes.
The 10(1)(a) is for movement and 10(1)(c) is in cases where supply is without movement.
Yes.
But when we read section 10(1)(a) and C, section 10 is only in case of other than imports or exports. So possibly in case of the import and export parts, we would not be able to rely on 10(1)(a) or 10(1)(c. Maybe just take an analogy out of that. But ultimately we'll have to rely on the citus itself, as you mentioned earlier.
No, you're absolutely right. You're absolutely right, Atul bhai, and that's the challenge. That if you start considering the definition of import, which says bringing into India from a place outside India, and therefore, if the Lal Products principle is applied to say that, okay, now I have brought this brand from Singapore to India. Okay. If it becomes import, then you are caught in the realm of Section 11. If you are caught in the realm of Section 11, Section 10 should not apply. Now, like Vaiti sir rightly pointed out, how will you tax this transaction? How will you file a bill of entry? The global principle is that you will not, tax intangible property or properties or digital transactions, so to speak. And this certainly is not coming on a media, right? So how are you going to tax it? Is the importer then going to file a paper physical bill of entry and pay tax on it? Are you going to ask the Singapore company to take a registration and say that you're liable to GST? I don't know how you're liable, but you're liable and therefore you pay tax. So implementation, sir, is a big problem in this case.
And practically filing a physical bill of entry might also not, I don't know whether practically that will happen. That will also not happen possibly.
Yeah, you're right. No, I'm just saying that the section continues to allow you to file a bill of entry. It doesn't say that you can only file on IceGate. So customs, you can go to the commissionerate and say, I want to file this. I know, I mean, practically it's a challenge, but the law doesn't prevent you from filing a bill of entry if you really want to.
True. Krishnan sir is there, sir. Would you like to?
Yeah. At the outset, speaker, chairman, it was fantastic, excellent thing. And since Pranav has given me the prerogative, two quick things. One is, in the case study 4, number 2 scenario, whereby deeming reverse charge is applicable because of the associate company. But where is the time of supply? There is no credit, there is no invoice, there is no payment. So really speaking, how the charge will get triggered?
Sir, there the provisions of Section 13 may come in our way because
13 of?
Section 13 of the CGST Act.
Yeah.
If you see, there is a residuary provision which says that if you cannot determine time of supply, then the tax period is going to be time of supply, right? So 13.5. So this provision was not there in point of tax rules, but there is 13.5. It says where it is not possible to determine time of supply, the time of supply shall be, in case of periodical return, has to be filed, the date on which return has to be filed. So it becomes a monthly time of supply then.
So you feel this will get triggered?
Yeah, there is a problem because there is a particular provision directly on this.
Okay. And the last case study, which is fantastic, what is the, perhaps you can take recourse to that. Government says it could be licensing or permanent. Both can be treated as services.
Yes.
So in an export case, whether it will help you to say it is a service. And the other thing is whether you structure the transaction to say that it's a licensing with an option after 10 years. I would request both of you to react that it's with an option to take it as your property if 10 years you pay my license fee.
I'm going to let Vaiti sir react to this.
We need 1 hour debate on this question.
Yeah. Because if government itself is giving you a thing by saying it is both licensing and permanent, both will be considered service, then do you think, including that, that's what one of the queries is saying, you know.
Yes, yes,
If you remember one of the queries,
It's the
he's
first
saying,
question. Yeah.
yes.
and the, no, not first question, correct, but juxtaposed to the the
Correct.
fifth scenario. In the fifth scenario, one of the queries says, if you are not able to do, it is convenient for you to treat it as services. Treat it, no.
In
That's what the
fact,
query says.
you have raised a very interesting question.
Yeah,
If you remember, both the questions are linked. When the speaker concluded the first case study by contrasting both the entries in the notification,
yeah,
referred to the annexure and said that the annexure only talks about licensing, and the word permanent is unnecessarily put into this entry.
yeah.
Is it can it be treated like that, or going by your theory of giving it a character of export of service?
Yeah,
May not say that the government in their wisdom decided to treat it as a service too, and who am I to remove a word from the entry in the notification?
yeah,
The only challenge would be is you may have to read it along with Schedule 2. And if you read it along with Schedule 2, the categorization of supply of goods and supply of service seems to be different, and there the permanent and temporary comes in.
yeah. But the category of Schedule 2 only says that if it is licensing of service, it will be service.
Yeah.
But doesn't say the reverse, that the permanent will be goods.
Right.
It doesn't say that. So that is why, that one of the queries is saying, if you are getting a rope, if you remember, just on a lighter vein, when a junior, he gets his sanat and he goes to a senior and he asks, what is the one piece of advice you give? So he says, when you are arguing, if you are strong on your facts, bang the facts. If you are strong on your law, bang the law. So the junior says, if you are neither, then bang the table. So what I think the queries want to say is, kuch nahi mila hai to, use that which the government itself give you the rope.
Why not? And sorry, I have not read the annexure in full. Is there other services in the licensing list? Any other segment?
No.
No, sir. The list is what I had put out. All kinds of licensing is covered in that same list.
Okay. No other such other licensing or something like that. Okay.